Okay, let's start. Good evening, everybody. Last week, we studied IAS 12 income taxes. We said there are so many taxes we pay in Nigeria, but the one that concern IAS 12, the one that IAS 12 cover is only two things, current and deferred tax. Now, the current is not much problem because the knowledge of the tax law helps us to understand the current tax where we apply the formula. But for the deferred tax, this is the income tax. If you can see my board, you have current and deferred tax. For the current tax, what do I need to know? Very simple. They are the calculation of current tax. The second one is adjustment of the previous year current tax on the current tax we are paying this year. Okay. Which two is either the over or the under provision for last year current tax, which we are going to carry forward to the next year. Good. Don't forget, tax is an estimate in the financial statements. We don't know how much we are going to settle with the tax authority, but we need to prepare the account based on the estimates. Then when we get there, they will tell us the reality. Same thing, let's go to deferred tax. Deferred tax is about temporary difference. If they don't say temporary, they will say timing difference, meaning the same thing. Then the movement of deferred tax to P or L, good. These are things we need to know in deferred tax. But let's move forward. With what we have done last week, we need to conclude today so that we can move to the next topic. Current tax, calculation of current tax. We have the formula, accounting profit, add back disallowable expenses, less allowable expenses, not taxable revenue, and we have a taxable profit. They will apply the tax to give you current tax. To give you the current tax. Now, then the over-under provision. Over provision will be seen the credit side of the balance, while under provision will be seen in the debit side. But we are not doing published account again. It's out of your syllabus. Now, the temporary difference. We say what brings about the temporary difference? A deferred tax is about the temporary difference. What brings about the temporary difference? Let's see. Now, as an accountant, I prepare accounts, where the tax people don't prepare accounts. The position of an accountant is to prepare and submit the accounts for tax person to adjust. Then I will prepare the account based on the tax law, based on the IFRS and IAS, based on the IFRS and IAS, and the tax person will adjust the account based on the tax law. So, then the way we see things, for an accountant, I will say accounting profit. The tax person will say, no, it's not accounting profit. It's a taxable profit. I will say depreciation as an accountant. The tax person will say capital allowance. I will say carrying amount. The other one will say tax base or tax written down value. So we are difference in view. The difference in view cannot be of type. It can either be permanent or temporary. For the permanent difference, they are all disallowable expenses. You cannot enjoy it later, this disallowable, such as fines, donations to political party. So all those are disallowable expenses. For temporary difference cannot be of two types. Sarah is a taxable difference or deductible difference. But it does not make meaning. This is where it makes meaning. Taxable difference will lead to deferred tax liability, while deductible difference will lead to what? Deferred tax assets. Now, when the carrying amount, who use carrying amount? Accountant. Is greater than the tax base. Who use tax base? Tax people. It will lead to what? Deferred tax liability. Okay, for deferred tax assets, when the carry amount is less than the tax base, the carry amount is not less than the tax base, it will lead to what? Deferred tax assets. Now, and I told you what can be inferred from the standard. When carry amount of an item in the financial statement is greater than the tax base, more than the tax base, it will lead to deferred tax liability, SOP. When the carry amount of an item in the financial statement is not less than the tax base, it will lead to deferred tax assets in where statement of financial position. Then, when depreciation is greater than the capital allowance, it will lead to deferred tax credit or deferred tax income in the P or L. But when depreciation is less than the capital allowance, it will lead to deferred tax charge or deferred tax expense in the P or L. We have used question to demonstrate this principle that we infer from the standard. Now, you can remind me, what is the last question we solved last week? I know question 1, we did question 4. I think we did question 2. What is the last question we did?
Question 19. Liberty PLC.
Question 19. Liberty PLC. Good, thank you so much. Do we take question on how do we determine the tax base when we are given carrying amounts? That is question number 7 and question number 4. Tola PSC. Question number 5. Tola PSC. Did we do that last week? And question number 7. Again, I said it's only. What is it?
No, we did only 19 and we did 17. We did question 4, question
Okay,
5.
Good, thank you, my sister. Now, look at these principles under here. Measurement principle in determining the tax base. In all, deferred tax can only come exam for in professional in 6 ways. I don't think there is unutilized tax credits and unutilized tax loss they will test, but I can bring one question to do that. But so far as we have, it is summarized solely 6. We have done the number 1 of it and the number 2. The number 1 of it is that they will say they bought an asset. They will give you the depreciation and the capital allowance, then the tax rate by the government. Where you get the carrying amount, you compare with the tax base to get either as a deferred tax liability or deferred tax assets in the statement of financial position and the movement to the POL. Or they give you depreciation. Now, the third one, they will give you the carrying amount, will now determine the tax base. Let's go to the question. By now, everybody has the question and the solution. Let's go to the question. Let's take question 5 to start with. Now, this is the question 5. Now, this is between the 2 perspectives of identifying deferred tax balance in the financial statement. It's only 2 ways. we can determine different tasks. Two methods. Some they say perspective, some say approaches, some say method. We have only two methods. The first one is the Farah method. The second one is the ability method. The Farah method make use of items in the statement of profit or loss. That's why some people refer to it as income approach method. They make use of the item in the P or L. Why? And liability method make use of the item in the statement of financial position. And liability method is the most popular one that we all know today. It's the most popular one we all know today. Good. Now, let's take this question now. Oh, that's okay. Let's go to the requirement of the question. The requirement says, compute the deferred tax provision. Don't forget, in exam, it is hardly you will hear they say deferred tax asset or liability. They will just say deferred tax. Why? Because we believe that deferred tax has a credit balance in the statement of financial position. Just like your PPE. PPE has debit balance. Just like your account balance, we expect account balance to be a credit balance. That does not mean that there can be debit balance. Get the logic, but expectation, same thing here. So, as at 31st December 2017, and the charge of profit or loss for the period in accordance with IAS 12 income taxes. Good. Believe by now everybody has the question. Let me share my board because we have a lot to do today. Can you see my board? Somebody can confirm to me, can you see my board?
Yes, sir.
Yes, sir.
Thank you so much. Now, dollar PS. So, let me click and see. Okay. Now, I was okay, dollar PSC. The name of the company. Dollar PSC. I will now show items. The carrying amount. The tax base. The TD. Tax rate. You see a deferred tax liability, or deferred tax assets. Now, I will now start. Item 1, they gave us PPE. And they've given me the current amount of the PPE to be 250,000. And the tax base is 218,750. Has it created a temporary difference? Yes. What is the difference now? I'll say 250,000 minus 218,750. That will give us 31,250. What is the tax rate given in the question? The tax rate given in the question is 30%, but they said it's expected to rise. It's just an expectation. did not make an announcement regarding that. Additional information 5. Tax rate is 30% for 2017. The government has not announced the tax rate for 2018, but it's expected to rise, just an expectation. So, just like we are expecting the fuel price to increase to 1.2, based on speculation, the government has not announced. And we pray that will not happen.
We solved this question last time.
Huh?
We solved this question last time.
Oh. Saw this question last time. Good. Let's. That's why I'm asking, do we solve this? Okay.
But it's not bad if you take it again, sir.
No. Let's take another one of similar this. Go
So
to
let's take
question
it again.
7. Question 7. We don't have time. We have so many things to do this night. Question 7. I don't think we don't take this question 7 last week.
No, we do not. We do not.
Okay, good. Blue bubbles. Blue bubbles. So now, same way we have done, I will say items, carrying amounts, tax base, temporary difference, the tax rates, deferred tax liability, or deferred tax assets. So I underline. Good. So with this, I will now start reading. Question 7. Blue Bubbles Limited is a public entity in the process of finalizing its financial statement for the year ended 31st October. The following information has been started for its accounting record for the purpose of deferred tax balance. 1. Inventory. Good. I'll mention the item. Inventory. Inventory is stated in the financial statement at the lower of cost and net realizable value. Good. Don't forget who used that. Accountants, IAS 2. Lower of cost and net realizable value. Good. Is the lower of one of the two. Then the company wrote down the inventory by 120 to a net realizable value of 1,130. So the carry amount is 1,130. What will be the tax base now? Let's continue this. The reduction in the value is ignored for tax purposes. Continuing inventory is sold. Who can tell me the tax base now? Let's do it together. Who can tell me the tax base? Who can tell me the tax base? Don't forget, look at it here. The cost, we don't know yet. But he said it was written down by 120. Then after we write it down, we have a net realizable value of 1,130. This is what he's saying. That means the cost is 1,250. Do you agree? Do you agree? This is what he's saying. Do you agree with that? Hello? Are we
Yes,
together?
sir. Yes, sir.
What is now the tax base?
Is it 120?
Wow, no. Tax people does not write inventory down. The amount you purchase it, 250, you will tell the tax people. They will record it. They now come, they say, our book, we have 250. How come? Say, no, we are applying principles of IAS 2. The principle says it's a lower of cost and net realizable value. So the inventory has been written down by 120. Will they agree to that? No. So the tax base will be what? Get the logic. Who use IAS 2? Accountant. It does not concern tax people. How much do you say you buy the inventory? That will be in their record. You will see that this inventory is not, the cost cannot be taken because I used to say it's lower of them. This inventory can only be sold at 130. So we are going to write down the inventory from cost to net realizable value to get the lower. But the tax people did not use that as a yardstick because they don't understand what is a ES2. That is why let's go back to the principles I'm telling you. And let's get the principle. It's just 4 principles you need to learn. This is the 4 principles. If an item in a financial statement is taxed on cash basis, the tax base will be 0. Don't forget, I have told you 6 ways. They will give you the carry amount. You will determine the tax base to get the different tax. That is the 3rd way. They will now go to current tax. We have done one last week. We'll do one again now. Now, the second one says, somebody says my voice is cracking. Is that true? Hello, somebody said my voice is cracking.
We can hear you, sir.
Is it clear? It's not saying it's not.
Yes, it is.
Maybe that is
It's
from his
good.
own
It's
end.
not big from his end, yeah.
Good. Now, Aramide Adebayo, please. Maybe you log out and come back home because it will confirm to me that if my voice is audible, they can hear me very well. Now, the second one says, if an item in the financial statement has already been used in arriving at the taxable profit, the carry amount equals to the tax base. The C, which you need to do, if an item in the financial statement does not have tax consequence or is not deductible for tax purpose, the carry amount equals to the tax base. And then lastly, application of accounting principles with the knowledge of the tax law to determine the tax base. That's what we have done now. IAS 2 was used by accountants, not tax people. Please. So has it created a temporary difference? Yes, it has created a temporary difference. What is the temporary difference now? 120. The tax rate of 30% was given. If you go to the second to the last additional information, or the last additional information, the income tax rate is 30% is applicable. So 30%. I will not look at it. Is it a different tax liability or different tax assets? I will check. Is it a different tax liability or different tax assets? Don't forget, we said when the carry amount is lesser. Excuse me. When the carry amount is lesser than the tax base, it will give us what? Deferred tax assets. I'll just say, oh, this is a deferred tax asset. 30%, 120 times 0.3. That will give us 36. 36. I'll go to the second one. Trade receivable. Now, under trade receivable, what did they say? Trade receivable have a current amount of 50 after making a general provision for that to date of tax. The provision is not allowed for tax purpose. Oh, carrying amount. Carrying amount is 450. What is going to be the tax base?
480.
480.
480. How? Because we make general provision.
Accountants.
Accountant does not concern tax people. Tax base, the temporary difference will be 30% of it. 30% of 30. You see a deferred tax liability or deferred tax asset. Deferred tax assets because the carry amount is lesser than the tax base. That will give us how many? I think that is 9.
9.
9. So 9. I will go to the next one. PPE. Oh, say PPE. What is the PPE? I will read. Property, plant and equipment has a carry amount of 3050 and a tax base of 2750. During the year ended 31st of October 2021, property was devalued upward by 150. So what is going to be give us? What is the carry amount? We have gotten the tax base to be 2750. What is the carrying amount now? Who can tell us what is the carrying amount? What is the carrying amount?
32.
How do you get to arrive at your 32?
It was revalued.
Oh, it was the value. Who used the valuation model?
Accountants.
Accountant. Does the class agree with the 3-2 answer?
Yes, sir.
Me, I disagree with the class. The question is just playing prank on me. He said the carrying amount. Don't forget, he said he's finalizing the financial statement. It means it's at the end. The carry amount of the PPE is 3050. Just as they say, your net salary is also amount to. Then I say after making some deduction, giving me the net salary. So he was just confusing us to say it will have been different if he said the carry amount as at the beginning of the year is 3050. But during the year, there was a revaluation upward or surplus of 150. That will have been 32. He was just trying to play prank on me to twist my brain. You have said this is the carrying amount. The account is being prepared at the end of the year. So I'm saying, so I will just say, 30. Has it created a temporary difference? Yes. I think that is 300. Tax rate of 30%. Is it a deferred tax liability or deferred tax asset? I will check. Is it a deferred tax liability or deferred tax assets?
Deferred tax liability
Liability. Why? Because the carry amount is greater
is greater
than the tax base.
than tax base.
So 30% of 300, I think that should give us 90. Then let's go to the next one. What did they say? The next one, development expedition. Now, let's say again. During the year to 31st October 2021, development expedition amount to 480 was capitalized. And amortization of 20 was charged to the profit or loss for the year. So he has capitalized during the year. It's not telling you, look at where it's wording it now. He capitalized, and that during that year, they removed 20. So what is going to be the carry amount in this question? It does not say the carry amount of development expenditure, not to confuse with the first one. It does not say so. Just say development expenditure capitalized during the year, and the amortization happened during the year, two of them, to get our final figure. How much is development expenditure? Said 480. Then the one we have consumed, 20. So the carry amount going to equals what? 460. Let's say, what is the tax provision? Okay. Development expenditure was allowed for tax purpose in full during the year. In full during the year. Who can tell me the tax base? Who can tell me the tax base?
Is it 460?
460?
480.
480?
Okay, it should be 480.
480? I disagree. Let me give this explanation now. For example, if you buy PP 100 million, and we have consumed, okay, let's say buy PP 100 million, and accountant say, I'm going to charge the position of 20. So at the end of the year, my PP will be 80. But the tax people say, no, we are going to give you 100% of the asset. Go and utilize everything. What is going to be in the tax base? Don't forget, we buy the asset at 100 million. We are charged the position of 20. So the carry amount is 80. But the tax people say, we are giving you 100% of that asset. What is going to be the tax base?
It's new.
500.
Huh?
Zero now.
500.
Zero.
Zero. Eh,
Yeah.
zero. If you get that, why can't you get this? The question is saying, look at what it says. Development expenditure was allowed for tax purpose in full, in during the year. What is going to be the tax base now?
Zero.
Zero. You see, how much you incur? Don't worry, we give you 100% of it. Is it zero? Just come, okay? The tax base, zero. The temporary difference will now give us 460. Tax rate of 30% is a deferred tax liability because development expenditure is an intangible asset. Just like brand name, goodwill, licensing, and VAPO. So 460 times 30%. 460 times 0.3.
138.
That will give me 138. Now, the last one. You also told us about trade and other payables. Trade and other payables. I'll go, okay? Trade and other payable. Let's see. Trade and other payable are carried at 600 million. Including the other payables are accrued expenses of 100 million, which later expenses are deducted for tax purposes on cash basis. So 600. What is going to be the tax base now? What is going to be the tax?
It's nil. It's cash basis, so nil.
I disagree.
500. 500.
Thank you. How is it 500? He said, let's see it again. How is it 500?
Okay, okay.
He said 100 out of the 500. 100, not the 600. It's
Okay.
100 out of the 600. That is tax on cash basis, not everything. You are correct.
Okay.
Anything with tax on cash basis must be what? Nil. But how much is nil here? It's 100, not the whole. So I will now come here. I will say 500. Temporary difference will now be 100. You see a deferred tax asset or deferred tax liability. You see a deferred tax asset or deferred tax liability. You see a deferred tax asset or deferred.
Assets.
It's an asset. Why? Because minus 500 is greater than
Minus
minus
600.
600. So 30% of 100 will give me what? 30. I will now sum them together. 36 plus 9 plus 30 to give me the assets. 36 plus 9 plus 30. That will give me 75. This will give me 75. Oh, that's okay. 90 plus 138.
228.
2,
228.
228. I will now say, oh, my deferred tax provision. This our deferred tax balance. As at which 31st October 2021. Deferred tax liability, which is 228. Then deferred tax assets, which is 75. This is my deferred tax provision at the end. When I say 228, 228 minus 75, that will give me 153. That's all. But what does the question request of us? What does the question request from us, the requirement? Say, compute the relevant temporary difference, which we have done. Then 2, deferred tax account at 31st October 2021, which we have done. Then, but look at it. It gives me the opening balance of deferred tax. If I want to get the one, I will go to the P or L. It gives me the opening balance of the deferred tax. For the opening balance, I can just say, oh, the one that will go to the POL, it does not request for it. And that's all. Divatas movements to POL now. The opening balance. What is the opening balance? 272. And we close the closing balance, which is 153. This is credit of NASE or income. Divatas credit / income, which is how much now? 272 minus. I think that will give us 119. Abi?
Yes, sir. Yeah.
Of that jacket, credit. If you require me to get different tax movement to the POL, don't forget I said, where are we still going? The tax expense is a combination. What is the tax expense? Is the current tax plus adjustment of the current tax, which can be under over, plus the movement in different tax will give me the total tax expense in the POL.
So please, how do you get your opening balance?
It's given in the question. Go to the note. They give me the opening balance. The second to the last, you will see the opening balance there.
Okay.
Exactly.
Yes, sir.
So we have done the third way. The question can be tested in exam. Let's go to the fourth one now. Calculation of current loss. Do I need to send this? Because the solution of this is in. Do you see one this?
Yes, sir.
What do you say?
Yes, sir.
Yes, sir.
Because the solution is on this. It's already okay, no problem. I'll do that. Now, let's go to question 15. The requirement says, compute the current year tax. The current year tax. Bodija. Let's go to the question to quickly read the question for your understanding. Okay. What are you seeing on my listing?
We are seeing the measurement principles in determining the tax base.
I don't know what is happening. Is it network?
Maybe, sir.
I'm sharing and the sharing is not, I don't know why. Yeah,
You can stop the sharing and then reshare again. It's gonna work.
no problem. I've seen the problem.
Yeah.
Can you see now?
Yes, sir.
So immediately after that, we go to question 14. Or let's go to the calculation in 14. We come out to 14. Bojan PSC had an accounting profit of 3 million. For me to calculate current tax, there must be accounting profit. I work from accounting profit to taxable profit. Accounting profit of 3 million for the year ended 31st December 2016. The following facts were discovered when reviewing the financial statement. Accounting profit was after depreciation of 200,000. What am I going to do to the depreciation? On property, plants, and equipment. Depreciation is a disallowable expenses that we add back. Second one, what do you say again? We order that the lease, plants, and profit on disposal of non-current assets was 3 million. Don't forget, it's still an asset. It has already been taxed by capital gain tax. This one does not fall under jurisdiction of current tax. Because when I sold an asset, it's a capital gain tax that will apply, which must have been applied before I get the profits. So it's a not taxable revenue. If it is profit, I will less. If it is loss, I will add. Then go for that. Plan and equip. Okay. Budget incurred development cost of 200,000, of which 50 has been amortized during the year, and the balance was capitalized. 50 amortization. Let us see what does the tax people says about development costs. Let's check down. Development cost is allowable deduction for tax in full in the year show expenses is incurred. This is what they normally say. So I will less the owe 200,000 trades. Now, let's go again. But the amortization, I will add back just like the depreciation. Boja owns plant and Boja owns a plant on finance lease. When it is finance lease, these are the treatments. The finance cost will be added back. Depreciation charge on the lease asset will be added, but the lease payments will be subtracted. Let me repeat myself again. Under lease, asset account under lease, the finance cost will be added back. It's a disallowable expenses. Why? Because they are going to give them the rates. The lease payments. Now, depreciation on the lease assets will be added back. Then the amount of lease payments is a deduction. Which the question will tell you. Let's go to it. All rental payments are deductible allowance. Good. Then we have done that. The company obtained sum of 10 million naira at the beginning of the year for the purpose of constructing warehouse. The rate of interest is 8% per annum. The amount qualified as a borrowing cost in line with IAS 23. Don't forget, interest on borrowing costs must be capitalized. And as such, the interest on the year ended 31st December has been capitalized. The tax people does not understand interest on borrowing costs. They say, yes, it's good, we collect loan for the business. The interest, why can't you remove it from your POL? Say, no, we used to capitalize. Say, who asked you to capitalize? Say, IAS 23. Say, who is IAS 23? Say, from UK. When the law of the land is talking, who is IFRS? So the law of the land is superior. So I'll now get the percentage of the interest on it, then I will remove it from the POL. Then, the 31st December 2016 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 Decem The sum of 200,000 was paid as a fines. This is desirable expenses. General provision has been increased. So it has been increased. I cannot take 500 or 400. It's the increment that went to the POL in that year, not the whole 500. Students used to make mistake of this. They have 400,000 as a provision in the book, but the now increase is the increment that they will debit POL and credit their liability with 100. So it's the increment I will now subtract. Good. Then, which they subtract, I will add back. Company donate 250,000 to political party, either APC or Labour Party or any party, we must add back the desirable expenses. With this, we can now easily solve the question. Let me share my both. Good. I'll now say, oh, I hope you can see my board.
Yeah, we can see, sir.
Good. Also good. So computation of current tax for the year ended. For the year ended 31st December 2016. Get my accounting profits. See accounting profits. What is the accounting profit? 3 million. The first one, depreciation. Depreciation on non-current assets. What is depreciation on non-current assets? 200,000, I will add back. Then profits on disposal of non-current assets. What do I add to the profit on disposal of non-current assets? 300,000. I will less. If it is loss, I will add. Then next, development costs. Cost incurred is going to be given in full, 200,000. Then the amortization of 50,000 added back. Or go again. What did you say again? Budget with the finance list assets, finance costs of 65 will be added. Of 65. Then depreciation on lease assets Release. Assets. How much is on this asset? 110 will be added back. Okay. So now, lease payments. The renter of 150 supported. Next. Oh, interest on borrowing costs. We obtained 10 million naira. That's the interest rate of 0.08. That will give us 800,000. Or not less. Don't capitalize. You less it from your next. Fines. The fines. How much is the fines? 200,000 was paid as a fine for contracting loss of 300,000. See these allowable expenses. Now, general provision has been increased. And that's okay. The increments in provision. Increments in provision. How much? 100,000. See these allowable expenses. Public donate to political party. Donation to political party. The word back. Now, if you go to additional information, capital allowance is claimed. Oh. Now see the capital allowance. Capital allowance. How much is the capital allowance? They say 10% per annum on building and 15% per annum on machinery. And apply on the tax original value of the asset at the beginning of the year. The tax original value of the plant and building. Okay, so for the plants, how much is the value of the plant? 500,000 times how much is applied? 0.15. 500,000 times 0.15. What does it give us? 0.15. 75. Then on building, how many percent is applicable in building? 10%. Now say 900 times 0.1. That will give us 90. So total capital allowance that will be deducted 165,000. This will not give me taxable profits. Then I'll apply the tax rate on it to give me the current tax. Good. That will give me taxable profit, will give me so we get the figure. Two first there. Then the tax rate of 30%. So my current tax will now give me 738,000. That's the end. Any issue? That's the end. That is the end. Any issue? Any question for me?
Yes.
What do you say? I am with you. In the absence of no question, let's go to another question. Let's go to what we are expected. Question 16. Let's go to question 16. Now, let me share that. This is a combination where we are going. Combination of the principles we have learned. Combination of everything. So, identify the tax base and the temporary difference for each of the items given. Calculate the current year tax for the year ended 31st December 2016. Calculate the VAT tax provision required as at 31st December 2016. Calculate the income tax expense for the year ended 31st December 2016. They will not ask you everything. What is my own duty in exam? Very simple. Very schedule. Before we share the book, look at the question. You see, the following information relates to ABC PLC as at 31st December 2016. Access they give us, we have to determine the tax base. Then all other information. Good. What do? I'll just come here and say, let me share my screen, the board. Which one is going to be even be better? Let me throw this into the class. Should I just go to the solution and be explaining all this as I'm solving it now? Which one is better?
Solving is better, sir.
Or should we test that one?
Let's hear from others, but the solving is better.
Now let's see. ABC. The first one say, the first question on it said, identify the tax base. That's a part of the question, which you have already know. You have done that. I said items. I will say carrying amount. I will say tax base. The TD. What is the tax rate? Deferred tax liability. Deferred tax assets. Good. This is the first requirement. A. B. What does it say? Calculate the current tax. We say computation of current tax for the year ended. What year ended? 31st December 2016. For me to calculate current tax, there must be accounting profits. See? It's a must. Follow come. What is the accounting profit? Does it give us? Yes. Accounting profit for the year ended 31st December 2016 was 350,000. 350. See, calculate the deferred tax provision. I can do that. Deferred tax at the end. See, deferred tax balance. Assets 31st December 2016. I'll open everything now. Next, calculate the income tax expense. Very simple. Income tax expense is the combination of the current tax. Okay, that's it. Tax expense, current tax, deferred tax movement. So POL. This is it. I will now start. PPE, property, plant. Now, what do I start with? Assets subject to investment relief. I will start. Assets subject to investment relief. What is the carrying amount? 63,000. Do they give me tax base? No. But there is a note to tax base. Note 1. The asset cost 70,000. Let me show the working down. Let's see. For the working, you can take here. Let's do the working here. For the workings. Good. Assets subject to investment relief. Good. Now, under it, they said note 1. Asset cost 70,000. So the cost of the assets is 70,000. Division rate is 10%. So times 0.1. That will give us what? 7,000. Oh, so that's why we see 63 as the carry amount. 70,000 minus 7. That's for the depreciation. For the capital allowance, what did they say? Good. The capital allowance The cost of the asset, 70,000. ABC tax consultants has advised that 42,000 can be claimed as a taxable expense. The capital allowance, $42. So the tax base, 70 minus 42, 28,000. Oh, come on. Don't forget, we need the depreciation and the capital allowance to calculate current tax. Come here and say, okay, the tax base now. Tax base. Has it created a temporary difference? Yes. 63,000 minus 28. Temporary difference of how much? 35,000. What is the tax rate? 30%. You see a deferred tax liability or deferred tax asset? Times 0.3. The tax rate was given in the question. Deferred tax liability, 10,500. Correct. We'll go to the next one. Land. Land. They have given me carrying amount to be 200,000. Don't talk about the tax base. No. Let's go to the tax base. Good. Let's go to the tax base. Additional information 2. The land was revalued during the year, following the principles of IAS 16. Who use IAS 16? Accountants. The original cost of the land was 150,000. Land is not subject to depreciation. The original cost is 150. They revalue by 50. Who use revaluation model? Accountant. What is going to be the tax base of the tax base? 150. Because it was not used revaluation model. The cost of the land. So the temporary difference, 50,000. Tax rate of 30%. 50,000 times 30.
15,000.
15,000. Is it a dividend tax liability or dividend tax asset?
Liability.
Because the carry amount is greater than the tax base. Done. Let's go to the next one. Plant and equipment. Plant and equipment. Now, what is the carrying amount? They've given
100,000.
me carry amount is 100,000. They also give me the tax base of 90,000.
Nice.
But they give me note 3. Let's go to note 3. The balance in respect of the plant and equipment are after allowing for depreciation of 12,000. After they allow for depreciation of 12,000. Good. For accounting purpose and 10,000 for tax purpose. Good. Why are they giving me those information? Because they know I'm going to calculate current tax. And depreciation is a disallowable expenses. Let me go and put it in my working. You have okay. What is the name of plant and equipment? For the plant and equipment, we have depreciation of 12,000. And we have capital allowance. Capital allowance of how much? Capital allowance of 10,000. 10,000. Good. Any issue? So I'll go back. Let me go and get my temporary difference. Temporary difference is 10,000. Tax rate is 30%. Say deferred tax liability or deferred tax assets.
It's a
Okay.
liability.
Liability 30% of 10,000,
3,000.
3,000. I'll move to the next one. Trade receivable. So trade receivable. They give me the current amount of trade receivable, 73,000. Now no tax base. There is a note to the tax base, which is note 4. Let's go to note 4. Trade receivable balance given above is made up of the following. Excuse me. Opening balance is 80,000. Allowance for doubtful debts, 7,000. There's nothing like that. They now get the closing balance of what, 73. In the tax people, there is no provision for doubtful debts. So what is going to be the tax base? It's going to be 80,000.
80.
Has it given us a temporary difference? Yes. What is the temporary difference?
Yes. 7,000.
7,000.
7,000.
Tax rate of 30%. You see a different tax liability or different tax asset.
It's an asset.
Different assets.
Trade receivable. How much is the asset now? 30% of 7,000.
2,100 naira.
Good. That is that. Then I say, oh, payables. On the payables, we have fines. How much is the fine? 10,000. No, we have interest receivable. But let's do this 10,000. Is there any information on it? Let's go to the notes. Why there's no information? Because information for captures other information. Say interest, the paralysis, receivable and payable are considered on cash basis. Interest, receivable, interest receivable, payables are considered on cash basis. So fine is a payable. Don't forget it's a liability. So the tax base will equal to what?
You mean interest receivables?
We'll go back. We'll go back now.
Okay.
Thank you.
Mhm.
10,000. 30%. You say deferred tax liability or deferred tax asset? You say deferred tax liability or deferred tax asset?
It's an asset.
Assets.
Asset of how much now?
3,000.
3,000.
Good. Let's go back to interest receivable. Let me shift a bit. Okay, let's go to interest receivable. How much is the figure for the interest receivable?
1,000.
1,000. Don't forget, it's on cash basis. When it is cash basis, tax base equals to what?
0.
1,000, 30%. 30% of the 1,000 is a deferred tax liability or deferred tax asset. This is a deferred tax liability of 300. Then we go to the next one, which is the interest payable of 3,300. Don't forget, it's a liability to us. We are paying payables, cash basis, 3,300. Tax rate of 30%. Say deferred tax liability or deferred tax asset.
Is an asset.
I will now go multiply 3300 times 0.3.
990.
That will give me 990. I will now solve. Let's try. Let's have it. Let's have it.
6090. 6090.
For asset, have it.
Yes, sir.
6090. Then for the liability, are you helping us?
Yes, sir.
Thank you.
28,800.
28,000.
800.
So he asked for the deferred tax balance. I'll just come here and say deferred tax liability, which is 28,800, and deferred tax assets, of what? 6090.
1090.
So this is my
20
deferred tax.
22,710.
22,710. So as at the end of the year, this for the VAT to ask me tax expense, it must give me the opening balance because the movement in the deferred tax that go to the tax expense together with the current tax. So I can calculate that. I've got 22,710, the closing balance. So let me do the whole. This is my working movements in deferred tax to POL. What is the opening balance? Let's go and check. What is the opening balance in the question? The opening balance, 36. 36. Then we close with closing balance, 22,710. So it's a charge to POL, charge or slash expense. And I say 22,710 minus 36.
19,110.
19,110. So I'll go and put that. I've gotten that. My tax expense. Don't forget. 19,110. You now remain the current tax. You just go to my current tax. I need depreciation. What is the total depreciation? 7,000 for assets subject to investment review. It's okay. For the depreciation, for the deed, we have 7,000 plus the one of plant and equipment. Let's get the figure. 12,000. See, disallowable expenses plus 12,000. Was the 12,000. This will give me 19,000.
19,000.
The capital allowance. We have 42,000 in one plus. How much is the second one? On the plant and equipment, 10,000.
10,000.
So we have 10,000. This will give me 52,000. Allowable expenses. I will remove. Next, I will now go to the table. Look at it. What affect this table? Oh, that can affect my POL. Assets subject to investment relief. We have used the depreciation. Land. Oh, there's a revaluation surplus of 50. Does it affect my POL? No. Revaluation surplus is reported in OCI. It does not affect accounting profits. Ignore. Plant and equipment. Yes, I've used the depreciation. Trade receivable. Oh, provision for doubtful debts. I'll now go to the provision for doubtful debts. And that's provision. We make provision for doubtful debts of 7,000. I will add back. I will add back. I will still go to the temporary difference table, different tax table, to go and check. Fines is on cash basis. It is when you pay the money, we will tax you. Why are you removing it now? Say, no, sir. We are preparing this account based on Akura, not on cash basis. So even though we have not paid the money, we will remove it. See, you have not paid the fines and you have removed it. You must be stupid. Say, add it back. When you pay it, then you will not talk. When I say fines of 10,000, we added back. Go to the table again. Interest receivable, 1,000, cash basis. See, they've not given us the interest, but the transaction has been consummated and we have earned the money. It's on an accrual basis, even though the money has not come in. It's occurring this year. It has to say, the money has not come in. Cash basis. You are saying accrual. So no. When you collect the money, we will tax it. Oh yeah, the one you have added, remove. You will now, okay. See, interest receivable. Or not less. So when you now collect the money, I will not tax it. It's on cash basis. Interest payable, the same thing on cash basis. Yeah, we have not paid the money, but we've removed the money because we are preparing account based on it happens during this year. See, have you paid this? No, it's payable. We make provision for it. Say, when you pay, then I can tax it. You're not now. So it's on cash basis. What do? You now add back. That is all. That is all. I will now come here. My sister, please, can you help us with the figure again?
Okay, sir.
Don't be annoyed, you.
No problem.
I will now see my taxable profits. And I get my taxable profits.
Three 300.
I will now come and say 336. 300, Abby.
Yes, sir.
Thank you, ma. Then the tax rate of 30%.
That's perfect.
Will now come here.
As
Now say
one,
current tax. Current tax. Of how much now?
100,890.
That's my current tax. The requirement of the current tax. Total tax expense. And now say current tax. 100,890. What is the total as expense now? 100,890 plus 19,110.
120,000.
When I go to the pure 120,000. If you can just say you do the extracts. If I want to do the extracts now, I will now say extracted statements of profits or loss for the year ended. At the first December 2016. That's expense. 120,000. And now say extracted statement of financial position as at 31st December 2016. Or say current liability. This place I won't take it to. Current tax. How much is our current tax? That is 100,890. I will now say not current liability. The deliver tax 22710. But it does not request for this. That is that. Any question from me?
Sir, I can't find the 3.6 opening balance in the question. I don't know if it's fine.
You can't find what?
The opening balance 3,600. Kindly refer.
Is there. After interest receivable and payable are considered on cash basis, balance of differs as at 1st January 2016 was 36. Have you seen that? Was 36.
No.
Is there.
Check after note 4.
Okay.
Any issue?
Yeah, I've seen it. Thank you.
Any issue?
Thank you.
If it does not give me, opening balance will be zero now.
Yeah.
That's what I was doing. Any issue? Let's go to the next question. Let's go to question 16. Questions. But that's what we do this. Question. John 15. Let's go to question 14, dominion. Let's go to question 14 and let's read the requirements. Now, do you have the question or do I put it for you to see?
We have it.
Okay. The question says, now let's see the question. Dominion Nigeria Limited owns the following property, plant, and equipment as at 31st December 2011. Plant and equipment, plant and machinery, 45,000. Land is 25,000. Accumulated depreciation, carry amount 36. Land 25. Good. Office building 75, 15,000 assist. Plant and machinery are depreciated on a straight line basis over the 5 years. Plant and machinery was acquired on 1st January 2011. Land is not depreciated. Good. Building and depreciated on a straight line basis over 25 years. Depreciation on office building is not deductible for tax purpose, so it cannot create a temporary difference. It's not deductible on office building. That means the carry amount will equal to the what? Tax base. It cannot create different tax. Temporary difference. For the plant and machinery, tax deductible is granted over a period of 3 years in the ratio 5/30/20. On the cost consecutively. The accounting profits before tax amount to 15,000 in 2012 financial year and 20,000 in 2013. The figure include non-taxable revenue of 4 million in year 2012 and 5 million in year 2013. The Dominion Nigeria Limited has a tax loss, good, in 2011. The tax rate in 2011 was 35% and 30% for each year of 2012 and 2013 required current tax and to calculate current tax. But we should be able to calculate 2013. But it was giving me accounting profits of 2012 and 2013. Definitely I'll use the two because they have said loss needs to be carried forward. We'll now say computation of current tax. The year ended. (2013) and 2012. So in 2012, 2013, let's remove 3 zeros. Accounting profits. . What is the accounting profit in 2012? Let's check.
50 million.
15 million, which is 15,000. Then in 2013 is 20.
20.
I need to add depreciation. It's allowable expenses. Let's go to the working down. Which page will be the working? Okay, let's do the working beside it. Let's do the working here. Okay. Depreciation. Two things we are depreciating here. Land is not depreciated. Then there's a depreciation on the assets. Plant and machinery. Okay. On plant and machinery, they've given me, what is the cost? It's 45,000.
45 million. Yeah.
They've given me the useful life of how many years?
And 5 years.
5 years. So depreciation to charge yearly, 145,000 divided by 5. Divided by 5 will give us what?
That's 9,000. 9,000.
Don't forget, the plant and machinery was acquired
2011.
Good. Then for office building,
Cost is 75.
for office building, the cost is 75. Cost of the assets, 75,000. What is the life of the office building? Do they give us?
25 years. 25 years.
Okay. Useful life, 25 years. So depreciation, 75,000 divided by 25.
That is 3,000.
3,000. So yearly depreciation will now equals to 3,000 plus
Plus
9,000, which is going to give us what?
12,000.
What do I do to this depreciation? It's a
Add back.
disallowable expenses. But let's do the capital allowance. Let's go for the capital allowance. No capital allowance on land. They say office building is not deductible for tax purpose, so you cannot create a temporary difference. So out of the 3 assets, only one can create a temporary difference, which is the plant and machinery, which will give us capital allowance. Don't forget, what is the source of temporary difference? Difference in the rate of depreciation and capital allowance. Office building does not pay temporary because the question has said it's not deductible for tax purpose. Don't forget, when things are not deductible for tax purpose, the carry amount equals to the tax base. It cannot create a temporary difference. If you can mingle with all the principles, no matter the way they want to throw the question, you'll get it. It's just that 6 ways. And I'm suspecting it this night because it has been long overdue for testing. So Year one, don't forget, don't let us use year one. Year 2011, where they purchased him 45,000 times how much they granted for the 50%, 0.5. That will give us 22,500. Year 2012, 45,000 times
Minus 22.
0.3, 30% of 45. How much is that? And this as
That is
usual,
13,500.
13,500. And let me check. Is it only me and you that is doing it? Because others are not talking it.
We are here, sir.
Our guy is going to sleep safe.
Yes, sir.
Listen. Then year 2013, we have 45,000 times 0.2. What does he give us?
9,000.
9,000. So don't forget, if I total it, it will give me 45,000. They will write it off in 3 years' time. Don't forget year 2011, no accounting profits. There's nothing I can do. They don't even request it at all. But in year 2012, I better say, I need the capital allowance. But the depreciation is here 12,000. Let's go up and go down and go side. I'll now say depreciation, which is going to be added back. Depreciation of 12,000. Then the capital allowance. We don't need 2011. We need 2012. Is it not 30,500?
Yes, sir.
In
Yes, sir.
2013,
9,000.
9,000. Is there not taxable revenue? Yes. They say there is not taxable. You have suffered tax initially. Not taxable revenue. How much is the not taxable revenue?
4,000.
Let's check. In
4,000 for
2012,
2012.
2012 is 4,000.
2013 is 5,000.
2013 is 5,000. Not taxable revenue. So this will give me, but there's a tax loss, taxable profit. Yeah, airport summit.
For me,
18,000 for 2013.
2013 is 18,000.
Yes, sir.
2012, encore. 2012,
9,500.
but there's a tax loss that is carried for from 2011. And also, tax loss brought forward. What is the tax loss brought forward from 2011 to 2012?
2011.
We have 12,500.
12,500.
So we still have a loss that we're going to bring 4 to 20 13.
13. Yeah.
What is the loss we are bringing forward?
3,000.
On average, 3,000. So
15,000.
I will now say my current task now. 15,000 times. What is the tax rate in
Times
20? Let's check. 30%. 15,000 times 0.3.
4,500.
That's for the current tax. And for the deferred tax, yes, for the deferred tax too, I'll use my table. Now say, okay, deferred tax table. Don't forget, out of the three assets, is only one that can give us taxable difference. That can give us temporary difference, which is plants, plant and equipment. I will now say year, carrying amount. That's this. That's this. The TD, temporary difference,
That's right.
tax rate, deferred tax liability, deferred tax assets. In 2011, day one of the purchase, 45,000. It involved the tax people, 45,000. We charge depreciation and capital allowance. How much is they not charge? How much do we charge? Let's see. 9,000. $22,500 was granted. This will now give 45 minus 9,000,
36.
36,000. $45 minus 22,500,
22,500.
has it created a temporary difference? Yes.
Yes, sir.
How much is the temporary difference?
13,500.
13,500. What is the tax rate in 2011? 35%. 35% times 13,500.
4,725.
4,725. Now, 2012, which is the opening balance of 2011. The closing balance is the video open. Depreciation, capital allowance. What is the depreciation we charge? Say 9,000. The capital allowance granted is 13,500. 36 minus 9,000.
27.
Then here will give us what?
9,000.
Oh, he has created a temporary difference. 27 minus 9,000. That will
18.
give 18,000. Oh, tax rate has changed. What is the tax rate now? 30%.
30%.
That means if in exam, in case, although they did not ask for this, I will now adjust. Don't forget. Let me show you. I will now adjust. I will say, if I want to get, let me, okay. Let me use this place. Now, I will adjust it. How do I adjust it? It's very simple. Who can tell me the formula? Do you still remember the formula? When tax rate changes. Who can tell me the formula? Because this tax rate has changed. Who can tell me the formula? We did it last week. I'll say different in rates. Different in rates. All over old rates times opening balance. Balance of derivators. Why? In case, although this one did not request, I will now say, oh, where's the value rate? 35 minus 5,000. That will give
That's
me
5,000. 5%.
5%. Thank you. Over old rate, which is 35%, times 4725. Where is he giving us now?
Mhm.
5% over 35% times 4725. Kilo by the figure.
Like 675 approximately.
675. Is it increasing or decreasing? Is the tax increasing or decreasing? Decreasing.
Decreasing.
So why? In case they give us, we have done this thing last week. Oh. Now, let's say 2011. I want to check the movement now. Movement in derivators. And I say year 2011, 2012. Opening balance, closing balance. Opening balance in 2011. What do we close with? 4725. Charge of 4725. Closing balance of year one. We now go to the, of 2011, we go to 2012. Then what do we close with in 2012? Let's go and check. One eight times 30%. 1/8 has 30%. 18,000 times 30%. Let me see. 18,000 times
5,400.
5,400.
400.
Now go back now. Look at it now. Although it does not request for it. And I say, oh, we close with 5,400 with a tax rate of 30%. But the opening balance here, it cannot fly because that one is at 35%. And it is not decreasing. So I'll now come here and I say 4725 minus how much do we get there? 4725 675. This is it. it will reduce my liability. My opening balance of my liability will reduce because the tax rate has come down. When we do that, what does it give us?
4,050 naira.
I'll now say 4,000. I'll now come here. 4050. I cannot get the charge now. By saying 54. What are you going to give us?
1350.
Hmm?
1350.
1350. That is it. In case it has to change, you will just apply the formula, different rate all over old rate times opening balance of the deferred tax. Now let's go back to what we are doing. Sorry for digressing. So year 2013, which question requests us for? The closing balance of 2012, depreciation capital allowance, 9,000. This will give me 18,000. 9,000. 18,000. Five four. So no movement. That's it. Any question? Any question? So deferred tax of 2013, 54. Current tax, 45. Let me ask you a question. If you don't want to ask me a question, me, I will ask you. Who can tell me the total tax expense? Who can tell me the tax expense that will go to the POL? Who can tell me the tax expense that will go to the POL?
Oh. 5, 4, plus.
What do we have for our current tax? Yeah. What do we have for our current tax? So in 2013, opening balance, 54. We also close with 54. So what is the total tax expense? Total tax expense that will go to the POL. Who can tell me? Who can tell me?
0.
Huh?
0.
Why is it 0?
That is the difference between opening balance and closing balance.
No, I disagree. That is not the total tax expense. That one is deferred tax expense. or credit. So what is my after tax expense? Don't forget that after tax expense is the current tax plus the movement in deferred tax to P or L. So if you ask me what is the total tax expense, I will just say current tax 45, deferred tax, total tax expense that we reported. Because there was no movement. Is the movement that will be added to the current tax. That's the logic. Is the movement in deferred tax after considering the opening balance and the closing to be added to the current tax. Any question for me?
Hello, sir.
Huh?
This deferred tax table is somehow confusing me.
Let's go there.
The table. So we
And
did
let me
for
show you the table.
2011.
Yeah, but what is confusing?
Okay. 2011, 2012, 2013. So, wait, sir, can I see the figure for 2013?
You can now.
I'm not seeing it. Okay,
Can you see now?
5-4. So everything is, we have deferred tax liability for the 3 years.
Why? Because the current amount is greater than the tax base.
Yes.
The current amount.
So, okay. So where did you get the 4,005? The current
4,000
tax.
is the current tax calculation. Should I go there?
Yes, sir.
Okay.
Okay, 15,000 times 0.2. Okay, I've seen it. Okay, sir, that one is clear. Then the deferred tax, sir. The deferred tax. Sir, can you come down? Yes, the tax expense.
Question, do we do it
Sir,
there?
come down a bit.
We did not do the tax expense there, unless you want me to do it now.
Sir, let's do it, sir.
Okay. Tax expense is the combination of the current tax plus the
And
movement
the
in
deferred
deferred
tax. Yes.
current tax, which is 4,500. But there is no movement in deferred tax.
Okay.
Because look at it here. Opening in 2012. Closing in 2012 will be the opening in 2013.
Okay.
Is the opening and the closing that the one that will go to the POL deferred tax, the closing, opening. Seller is going to be charged or credit that goes to the POL. Any issue now? Next question. We're almost done with all the questions here. Now, you two, let's read question 8 together. Tell me. Look at what is tested for 7 marks. Question 8 together. The organization, Deep Prince, yes, is in the process of drafting the annual report. Who is watching football? Annual report for the year ended 31st October 2014. You have been mandated to prepare the notes in respect of the debaters. The debaters account has a credit balance of 48 million as at 31st October 2003. Good.
So which question are you reading?
Question 8. Question 8. Question 8. Question 8. Question 8. Question 8. The organization, the Prince, is in the process of drafting annual report for the year ended 31st October. October 2004. You have been mandated to prepare the notes in respect of the debaters. Debaters account has a credit balance of 48 as at 31st of October 2003. Does that one pass message to you? Does it pass message to you? Debaters account has a credit balance of 48 million as at 31st of October 2003. And they want me to prepare for 2004. Definitely, it has passed a message. Please, which message does it pass? Somebody should talk. Which message does it pass? That is the opening balance of my debaters. Very simple, just the opening balance. Of how much? 48 million. This is the opening balance. No issue on this. Only the amount arose as a result of the difference between depreciation and capital allowance. For the year ended 31st October, company charged 576 in depreciation, so he has given me depreciation. I have known my opening balance of debaters. He has given me depreciation. How much is depreciation given to me? 576. And the capital allowance claim of capital allowance, which is 665.6 in capital allowance. The income tax for the year, that is the current. Income tax for the year, that is the current. Is how much? 150 million. Assuming cut of tax rates, 30%. Because the purpose of debaters and how it can be accounted for. Prepare note in respect of debatization of the PSC. This should be suitable for publication. Yeah. What does he ask me to do here? Who can tell me? What does he want me to do here? Based on what we have done so far, this one is straightforward. Don't forget. Oh, you have given me division and capital allowance. I can get the one that will go to the POA direct, the VATAS that will go to the POA, which you have done. I'll just come here and say, okay, year 2004. Depreciation. Capital allowance. Temporary difference. Tax rates. You see a charge or credit. One of the two. How much is the depreciation figure? 576. I'll come and say, okay, 576. Capital allowance now. How much is the capital allowance given in the question?
685.6.
Has he created a temporary difference?
Yes.
What is the temporary difference now? What is the temporary difference?
89.6.
for tax purposes in the future.
89?
So if there is a temporary
89.6.
Okay.
written of 4,000, but the revenue authority is saying no.
9.6.
That so they have increased, they have included that 4,000.
Somebody is tax rate of 30%.
Welcome to the battle of balance money. That's IAS for. Over here, the most important that we are going to talk about is
somebody is
26.88.
making noise. Somebody's speaker is making noise. Eh?
26.88.
Is he a charge or credit?
Is a
Is he a charge? Is he a charge or credit? You have not memorized. It's a charge.
is a
When
charge.
the video is left, it's a charge.
Yes, a charge.
Good. Look at it now. Closing balance of the VATAS. What is the opening balance?
48 million.
And as a charge for the year. What is the charge for the year?
26.88.
This is 7 marks for basis year question. 48 plus 26.88.
Yes. 74.88.
I'll go to the tax expense for the year. Current tax, which is the income tax assessment they've given as 150. Is it 150.4
Yes, sir.
or 150 million?
150.4. 150.4.
150.4. On as a deferred tax. charge 26.88. Ah, I see disappear.
We can't see the voice.
Total. 150.4 plus 26.88.
One seven seven
What does it
point
give
two
us?
eight. 177.28.
177.
177.28.
0.28. That's it. Can you see? Can you see that?
Yes, sir.
We understand that thing very well. In short, we will see everything as they are saying it. Any issue?
The requirement is saying that we should prepare notes. So this is what they mean by we should prepare the notes in respect of deferred
The
taxation.
remaining one is just to use notes. This is what he's saying. When they give you the question, you will see it. Just follow the principles. Is the movement in deferred tax I will add to my current tax to give me the tax expense. Now, let's go to a complicated question. Go to question 9. 9. Are you there?
Yes, sir.
Okay. In January 2000, Mani purchased 450,000 worth of computer equipment. The company initially intended to depreciate over 6 years, depreciation, on a straight line basis. However, in year 2002, the fast pace of technological change in its business sector caused Mani PLC to write off the book value at once. When does it write it off? 2002. The capital allowance on the assets is granted at 20% of cost per annum on a straight line basis. The current tax was 25% from years 2000 to 2002. In 2003 and 2004, it was 35%. Money profit before depreciation was 420,000 for each of the 5 years. The carry value and the taxation value of the non-current assets and mean pay goods. As at the beginning, nothing happened. I mean, you are required to calculate the current tax charge for the year ended 31st December 2004. Simple question. Calculate the deferred tax balance and charges for the years ended 31st December 2002 to 2004, and prepare the profit and loss account. Start. We have less than 30 minutes. Or 30 minutes to solve the question. Good. Money. I'll say computation of current. That's for the year ended 31st December 2000 to 31st December 2004. So the year, we have 2000, 2001, we have 2002, 2003, and 2004. Based on the question. Good. Then he has given me accounting profits. How much is the accounting profit? Profit before depreciation. So he has not removed the profits before depreciation, not accounting profit. He has not removed depreciation out of it. Profit before depreciation. I'll go there. Profit before depreciation. 420,000. 420,000. 420,000. 420,000. Good. Don't need to what? To add back depreciation. He has not subtracted capital allowance. Nancy? Capital allowance. With tax authority, how do they grant capital allowance? It's granted 20%. So let's go and calculate capital allowance and depreciation. Depreciation, 450,000. How many years? What is the useful life of the years? Yeah, depreciation, 450,000.
6 years.
6 years.
Yes.
Thank you, my sister. 6 years. How much is depreciation? 450 divided by 6. And then that will give us, how much is that?
75,000.
75,000. Then the capital allowance granted. Say 20% on the cost. So 450,000 times 0.2. So that is 90,000.
Yes, sir.
We'll go back. We have gotten the depreciation and my capital allowance. Good. I will less the capital allowance. This will now give me taxable profits. How much is the taxable profit?
330,000.
330,000. Then the tax rates, which are differ. Mm.
25% for 2,000.
25%. 25%. 25%.
35%.
35% here.
35%, yes.
35%.
35%.
So with this, you are making the job easier. Thank you so much, man. With this, I can calculate my current house. Now the current house. How much is the current house?
82,500.
82,500. 82,500. 82,500. No, no one cannot be 82.
115,500.
115.
500.
And these are two.
Yes.
115.
500.
That is the first requirement. The second requirement, calculate the debitor's balance and charges for the year ended 31st December 2000. Let me calculate my debaters. I'll use my debaters table. Debaters table. I'll say okay. Year. Running amount. That's base. Temporary difference. Tax rates. Deferred tax liability. Deferred tax assets. $2,000. 150,000 assets. About how much is the assets?
450,000.
150. 150. Depreciation / capital allowance. How much depreciation was charged?
90,000.
I will remove. The capital allowance of 150 minus 90,000.
3
what?
360.
360,000. The capital 450 minus 75,000.
375.
375,000. Has it created a temporary difference?
Yes, sir.
Let's see. I'm not sure that we shall see. Where do we calculate the depreciation and the capital allowance? want to be sure. Depreciation is 75. Capital allowance is 90.
Oh, okay.
Depreciation is 75.
25.
Depreciation is 75. So the capital allowance is 90. Oh, yeah. That's okay. 75. Capital allowance is 90.
90.
That means this one is wrong.
375.
375. This one.
360.
That's okay. This 75. This one is 375.
Yes, sir.
This one is 360. What is the temporary difference now?
15,000.
15,000. Tax
Tax
rate
rate
of
25%.
deferred tax liability or deferred tax assets.
Deferred tax liability.
Of how much now?
3,750.
3750. For 2001, depreciation / capital allowance. Depreciation of how much was charged?
75.
75. Capital allowance of 90.
90.
This will give us 300. 360 minus 90.
270.
30% of 30,000.
Is it 30 or 25%?
25%, Josh. Thank you. 25%.
75.
2002.
75.
Depreciation?
75,000.
No, it was written off.
Okay.
The question says in 2002. Where is it? Yes, in 2002. That was the first place of the government changes in business sector. Because the place to write it off book value.
That one's okay.
So this one will charge what? 90.
Okay.
So this will give me nothing. 270 minus 90. 270 minus 90.
180.
180. 180. 25%. 25% of 180.
45,000.
But now it's not a liability, it's
The
an asset.
assets.
Then 2003, depreciation capital allowance. $90.
35%.
It has not changed now, 35%. You are following my sister.
31,500 assets.
31.
500.
I'm you lady now. What about others? We should not sleep. We are together. 2004. Depreciation and capital allowance. So So
Yeah.
that is the second requirement of the question. Part of the second requirement. He said, you want to go to the SFP? Go ahead now. Let me find space. Oh. But do you remember the figure?
Oh, which one, sir?
Don't worry. Now, we have year 2000, 2001, 2002, 2003, 2004. SFP now, and POL. What is the deferred tax balance in 2002? 3750. Do we agree? Let's go and check.
Listen, 150.
45 and 31,500. Can you see? There is
Yes,
nothing
sir.
in the last one.
Yes.
There's nothing. Have you?
Yes, sir.
Good. 75 is the second one. Then 45. Yeah, we have 75. The second one is what? 45,000.
45,000.
Assets. An asset. The 2003 we have
31,500.
assets.
Yes.
The one I will go to the POL. Let's do POL. We have movements in deferred tax. We have the years 2000, 2001, 2002, 2003, opening balance, then the closing balance. We close with 3750, nothing. So charge of how much now? 3750.
3750.
Yeah, 3750.
50.
What do we close with?
75.
75. So 75 minus 3750.
3750.
Yeah,
Yes,
75.
sir.
What do we close with?
45,000.
But credits.
Credit is
So what's going to happen? Yeah. What is happening? Yeah, give me figure
the
now.
charge.
Charge again.
37.
Or
Sorry,
sustain.
credits.
Okay. Of how much?
52,500.
That is it. 52,500 credit. In 2003, tax has changed. In 2003, tax has become from 25 to 35%. So I need to adjust my opening balance by saying, oh, different in rates over old
Old rates. Rate.
price opening
Opening balance.
of deferred tax. Different in rate will give us 10% over times what is the opening balance? 45,000, which is credit. My credit will increase. Oh, yeah. Next. Give me a figure.
18,000.
How much?
18,000.
80,000 credits.
Yes, sir.
We'll now say 45,000 plus 18,000 total credits. What does it give us?
63,000.
63,000 credits. We'll now go up now. I've adjusted that. Where is it? We'll now say 63,000 credits. What do we close with?
81,500.
Credit, Abby.
Yes, sir.
So, what will happen now? Yeah. What does it give us? Credit or charge?
94,500.
Yeah, us are straight.
Is it not credits?
Bigger credit. It's charge.
81,500. Okay.
When we remove that, you give me 31,500. In 2004, credit was 31,500. But what do we close with? Nothing.
0. 81,500.
So I can now fill in the gap now. I can now fill in the gap. My POL. The first one is 3. Second one is what?
Oh. Yeah. 75.
67. Third one is 51. Is it 51 or 52?
52, 500.
Oh. 52. Will now pick 52, 500. This one is 31.
500.
Are you sure? I'm not so sure.
That's the charge now.
Let's see. Oh, it's 31, 500. $31, 500. And now you see how you pay your accounts. My total tax expense. You have space. No more space. Let's see. You have space now. So total tax expense for year 2000, 2001, 2002, 2003, 2004. First one, I would say current tax and the movement in my deferred tax. Current tax is 82,500. Deferred tax is 3750. This is the total tax expense I will use to be paying the account. In 2002, we have 82,500. What is the deferred tax movement in 2001? Yeah,
75.
it is recorded already. 75. Then in 2002, 52,500, but there is a credit of 51, 52,500. So you can go and study the meaning in the solution. This is 11:30 already. Any question for me? Thank you, myself. Yeah. Any question for me? Any question?
I don't have question, but if I have, I will chat you up, sir.
No problem. You are free.
Yes, sir. Thank you, sir.
Okay. So, good night, everybody. Bye.